Markets closed. Bell rang. And right now, while you sit there, something is already moving. Something that doesn't care about market hours and doesn't care about your brokerage app, doesn't care that it's the weekend. A Black Swan doesn't wait for Monday. It doesn't wait for the opening bell. It doesn't wait for you. Silver just did something tonight that hasn't happened in modern trading history. And by the time that bell rings again on Monday morning, it will already be too late. Welcome to Currency Archive. If you've been with us for a while, you already know. We don't sugarcoat things here, and if you're new, well, you picked quite a night to show up. Now, before we go any further, if you're watching this, you're probably the kind of person who doesn't just trust what the news tells you. You ask questions, you do your own research. That's exactly why this channel exists. So do us a small favor, the same way you'd ask a trusted old friend to save you a seat. Hit that subscribe button, just once. That's all we ask. Because what's coming in this video, you're going to want to be notified the next time we sound the alarm. And one more thing, drop a comment right now. Tell us where in the world you're watching from tonight. Because this story affects every single one of you, no matter where you are. Now, let's talk about what's really happening. Every Friday afternoon, at precisely 4 p.m. Eastern Time, a bell rings on the floor of the New York Stock Exchange. For most people, that bell means nothing more than the end of a trading week, a signal to close the laptop. Check the portfolio one last time. Maybe pour something cold and forget about the markets until Monday morning. But for those who understand what that bell actually represents, it is not a relief. It is a warning. Because when that bell rings, something very specific happens to every single paper asset sitting inside every brokerage account across America. It freezes. The price stops moving. The buy button goes dark. The sell button disappears. And the investor, no matter how wealthy, no matter how experienced, no matter how many Bloomberg terminals sit on their desk, becomes completely powerless. They cannot react. They cannot adjust. They cannot protect themselves. And the world does not stop. This is the structural reality that financial television never explains clearly. Markets are not the world. They are a window into the world. And that window has opening hours, Monday through Friday, 9:30 to 4. Outside of those hours, the window is shut. But behind the glass, everything keeps moving. Geopolitical decisions are made on Saturday mornings. Currency interventions happen on Sunday nights. Supply chain disruptions do not file paperwork with the SEC before they occur. Wars do not wait for the opening bell. And this is precisely where the concept of a gap event is born. A gap event is what happens when the price of an asset on Monday morning is dramatically different from where it closed on Friday afternoon, not because of something that happened during trading hours, but because of something that happened in between, in that silent 65-hour window where markets are closed, but reality is not. For equity investors, gap events are painful. For bondholders, they are destabilizing. But for silver, a gap event can be generational. History has recorded these moments with uncomfortable clarity. In September 2008, Lehman Brothers collapsed over a weekend. When Monday arrived, markets did not gradually decline. They opened in free fall. Investors who held paper assets through that weekend had no exit. The gap had already happened before they could act. In March 2020, pandemic fears crystallized over a single weekend. By Sunday night, futures markets were already down 5%. By Monday open, the gap was visible to everyone, but the opportunity to position ahead of it had already closed. Those who understood the mechanics of weekend risk were not caught off guard. They had already moved. They had already adjusted. Because they knew something that most retail investors still do not fully appreciate. The gap does not form on Monday. It forms on Friday, the moment the bell rings. Now consider silver specifically. Silver is not gold. It does not move with the slow institutional grace of a reserve asset. Silver is industrial. Silver is monetary. Silver sits at the intersection of manufacturing demand, geopolitical tension, currency debasement, and speculative positioning, all at the same time. This makes silver uniquely explosive during gap events. When a shock occurs over a weekend, silver does not drift higher. It jumps. It reprices violently and without mercy. And because silver's market is significantly smaller than gold or equities, the gap moves are proportionally larger. A shock that moves gold 2% can move silver 8% in the same breath. And right now, as this particular Friday closes, the silver chart is showing something that experienced technical analysts have not seen in years. The weekly candle has closed at a level that represents a clean structural breakout, not a test of resistance, not a near miss, a confirmed close above a price level that has held silver back for the better part of a decade. That kind of close on a Friday, with markets now shut for 65 hours, is not normal. It is the kind of setup that creates the conditions for exactly the kind of Monday morning that investors spend years trying to either catch or survive. Most people use the term Black Swan incorrectly. They use it to describe something surprising, something unexpected, something that came out of nowhere and shocked everyone equally. a natural disaster, a sudden market crash, a headline that nobody saw coming. But that is not what a black swan actually is. The economist Nassim Nicholas Taleb, who gave the world this concept, was very precise about its definition. A black swan is not simply a rare event. It is a rare event that carries extreme consequences, that appears obvious in hindsight, but that the majority of market participants failed to price in beforehand. That last part is the most important. It was visible, it was measurable, but most people chose not to look. And right now, this weekend, while retail investors sleep and financial television runs its weekend programming about housing markets and personal finance tips, three very specific forces are converging simultaneously. Each one alone would be significant. Together, they create the structural conditions for exactly the kind of Monday morning that rewrites portfolios permanently. The first force, the COMEX inventory crisis, reaching a critical threshold. For months, analysts tracking the physical silver market have been watching one number with growing alarm. The registered inventory at COMEX, the silver that is actually available for immediate delivery against futures contracts, has been declining at a pace that does not match the calm, orderly price action visible on the surface. As of the most recent vault reports, registered silver inventory sits at levels that represent a fraction of the open interest in silver futures contracts. In plain language, this means that the number of paper claims on silver dramatically exceeds the amount of physical silver available to honor those claims. This is not a new observation. But thresholds matter in financial systems, and the current inventory to open interest ratio has crossed into territory that historically precedes forced delivery events, short squeezes, and violent price dislocations. The COMEX system functions on trust and probability. It assumes that not everyone will demand physical delivery at the same time, but when confidence in that assumption begins to crack, the repricing is not gradual, it is instantaneous. The second force, the Shanghai premium signal. While Western markets were closing their books this Friday, something was already being priced into Eastern markets that most American investors never monitor. The Shanghai Gold Exchange silver premium, the difference between what physical silver trades for in China versus the international paper price, has been widening consistently over recent weeks. This premium is not a technical anomaly. It is a real-time signal of physical demand pressure in the world's largest manufacturing economy. When the Shanghai premium expands, it means Chinese industrial buyers and institutional accumulators are willing to pay above the international benchmark price to secure physical silver. They are not waiting for Monday. They are not waiting for a better price. They are buying now at a premium because they believe the international price is about to move sharply higher. Eastern markets have a consistent historical pattern of front-running Western price dislocations in precious metals. They positioned ahead of the 2011 silver surge. They accumulated aggressively before the 2020 repricing. And right now, the premium data suggests they are positioning again. The signal is there. It has been there for weeks. Most Western retail investors have simply never been taught to read it. The third force, the geopolitical fuse that does not observe market hours. There's a principle that serious macro investors understand deeply and that financial television almost never discusses honestly. Geopolitical risk does not price gradually. It prices all at once. For months, a specific set of pressure points across the Persian Gulf, Eastern Europe, and the South China Sea have been building with a kind of slow, structural inevitability that only becomes obvious after the event has already occurred. Supply route vulnerabilities, energy corridor tensions, strategic mineral access disputes that directly implicate silver's role in defense manufacturing and next-generation technology production. None of these pressures disappeared when the closing bell rang on Friday. They are still active, still developing, still capable of producing a headline between now and Sunday night that permanently alters the risk calculus for every precious metal position on the planet. And here is the critical point that most investors miss entirely. Silver does not need a confirmed catastrophe to gap violently on Monday morning. It only needs the credible threat of one. Market's price probability, not certainty. And right now, the probability of a significant geopolitical development over this specific weekend is higher than it has been at any point this year. The Black Swan is not coming. It is already in the room. It has been sitting quietly in the corner, while everyone looked the other way. And when Asian futures open Sunday night, the room is going to get very, very loud. There's a moment that experienced traders dread more than any other. It is not the moment the market crashes. It is not the moment the headline breaks. It is not even the moment they realize they were wrong about their position. It is the moment they open their brokerage app on a Monday morning and discover that the price they were planning to act on no longer exists. It moved while they were sleeping. It moved while the alarm was still set, while the coffee was still brewing, while they were reaching for their phone with the casual confidence of someone who believed they still had time. They did not have time. The gap had already happened. And this is not an accident. This is not bad luck. This is the precise, mechanical, almost clockwork process by which major price dislocations in silver, and precious metals broadly, express themselves in the modern financial system. Understanding this process, step by step, is the difference between being positioned correctly before Monday and spending Monday morning watching a move that can never be recovered. It begins on Sunday at 6 p.m. Eastern Time. Most retail investors do not know this. Most financial television does not cover it. But every serious precious metals trader marks this moment on their calendar every single weekend. At 6 p.m. Eastern on Sunday, the CME Group's Globex electronic futures platform reopens for trading. This is not the full market open. This is the pre-session, the quiet open. The moment when the first institutional orders begin hitting the silver futures tape after 65 hours of complete market silence. And in a weekend where significant forces have been building, geopolitical pressure, inventory stress, technical breakouts, this Sunday open is not quiet at all. The first trades that print on Globex Sunday evening represent something very specific. They represent the informed money. The desks that spent the weekend reading intelligence reports, monitoring Eastern physical demand flows, tracking geopolitical developments in real time, and running quantitative models that retail investors do not have access to. These are not guesses. These are calculated positions placed by institutions that cannot afford to be wrong. And when those first prints come in significantly above Friday's closing price, the gap has already begun. Then the Asian session takes over. Tokyo opens at 7 p.m. Eastern. Sydney is already active. And by the time Shanghai opens in the early hours of Monday morning Eastern Time, the Eastern institutional complex has had several hours to react to whatever developed over the weekend. This is where the Shanghai premium signal, discussed in Part 2, becomes critical. If Chinese physical buyers spent the weekend accumulating at a premium, their institutional counterparts enter the Monday Asian session with aggressive buy orders already queued. They are not reacting to the gap. They are completing a purchase they already decided to make. The silver price, already moving higher from the Globex open, accelerates. Each uptick triggers algorithmic responses from momentum-following systems that monitor price velocity across multiple exchanges simultaneously. These algorithms do not analyze fundamentals. They do not read geopolitical reports. They simply observe that price is moving with unusual speed in one direction, and they join it. This is the cascade. One institutional buy triggers an algorithmic response. The algorithmic response moves the price. The price movement triggers another algorithmic response from a different system. And within minutes, what began as a measured institutional position becomes a self-reinforcing wave of automated buying that pushes silver higher faster than any human trader can manually process. The short squeeze ignites. Now consider what is happening simultaneously to the traders who were positioned on the wrong side of this move. Silver futures have a significant short interest, meaning a substantial number of traders have placed bets that silver's price will decline. These short positions were placed based on Friday's market conditions, Friday's price levels, and Friday's risk assessment. But Friday's conditions no longer exist. As silver gaps higher on the Sunday Globex open and accelerates through the Asian session, every short position in silver futures begins losing money at an accelerating rate. And futures trading has a mechanism that makes this situation uniquely dangerous for short sellers: the margin call. When a futures position moves against a trader beyond a certain threshold, their broker automatically demands additional capital to maintain the position. If that capital is not immediately available, and on a Sunday night, for most retail traders it is not, the broker closes the position forcibly. A forcibly closed short position is a forced buy order. Thousands of forced buy orders hitting the market simultaneously during a period when liquidity is already thin and algorithms are already accelerating the move upward creates a feedback loop of extraordinary violence. The price does not move higher steadily. It lurches. It jumps in increments that would be shocking during normal trading hours, but are structurally inevitable given the mechanics at work. This is the short squeeze. And once it ignites, it does not stop until every trapped position has been forcibly closed or voluntarily abandoned at maximum loss. The London fix arrives, the move becomes official. By the time the London market opens, approximately 3 a.m. Eastern on Monday morning, the silver price has already traveled a significant distance from Friday's close. London's opening fix, the benchmark price used by institutional buyers, dealers, and refiners across Europe, confirms the new price reality. At this point, the gap is no longer forming. It has already formed. And when New York opens at 9:30 a.m. Eastern, when the retail investor finally sits down with their coffee, opens their brokerage app, and sees the silver price for the first time since Friday afternoon, they are not looking at an opportunity. They are looking at a history lesson. The move happened between 6 p.m. Sunday and 9:30 a.m. Monday. A 15-and-a-half-hour window during which every mechanical force in the global silver market expressed itself completely and without mercy. The investor who understood this process was positioned before Sunday evening. The investor who did not is now deciding whether to chase a price that has already moved or wait for a pullback that may never come. There's a fundamental difference between two types of investors. The first type watches events unfold, then reacts. The second type understands the mechanics of how events unfold and moves before they do. This distinction sounds simple. It is not. Because reacting feels like participating. It feels like engagement. It feels like decision-making. But in the context of a Black Swan gap event in silver, reacting on Monday morning is not a strategy. It is damage control. And the painful truth that most financial advisors will never sit across a table and tell their clients directly is this. By the time the average investor sees the move is already over. The institutional money entered on Sunday night. The algorithms amplified through the Asian session. The short squeeze completed before London opened. And the gap printed permanently into the chart before a single mainstream financial headline was written about it. What remains for the late participant is not opportunity. It is the echo of an opportunity that has already passed. The first strategic reality, paper silver and physical silver, are not the same asset in a gap event. This is perhaps the most critical distinction that serious investors must internalize before this weekend concludes. Paper silver, SLV shares, futures contracts, silver ETFs, mining stock positions, exists entirely within the brokerage system. It cannot be accessed during market closure. It cannot be repositioned on Sunday night. It cannot be adjusted as the GlobeX session opens and the gap begins to form. It sits frozen, legally and mechanically inaccessible, while the repricing happens around it. Physical silver operates under an entirely different set of rules. An investor holding physical silver in their possession does not experience a gap event as a crisis. They experience it as a confirmation. Their asset repriced while they slept. They did not need to click a button. They did not need a brokerage app. They did not need market access at 6:00 p.m. on a Sunday night. The metal in their hand is worth more on Monday morning than it was on Friday afternoon. No action required. No timing necessary. No margin call possible. This is not an argument against paper silver in all circumstances. Paper silver has legitimate uses in liquid, functioning markets. But in the specific context of a weekend Black Swan gap event, the precise scenario unfolding right now, the structural advantages of physical positioning over paper exposure are not subtle. They are absolute. The second strategic reality, mining equities offer leverage, but carry timing risk. For investors who understand silver's directional move but seek amplified exposure, silver mining equities historically provide leverage to the underlying metal price. When silver moves 10%, well-positioned mining companies with low production costs and strong balance sheets can move 20%, 30%, or more. But mining equities carry a specific risk in a gap scenario that physical metal does not. They open on Monday morning like every other equity. They are subject to the same gap dynamics, the same algorithmic momentum, and the same liquidity constraints as the broader market. An investor who attempts to enter mining positions at the Monday open, after the gap is already printed, is not capturing the move. They are paying the maximum price for exposure to a move that already happened. The strategic window for mining equity positioning in a gap scenario closes on Friday afternoon. After that bell rings, the opportunity has already begun to expire. The third strategic reality, portfolio allocation logic in a Black Swan weekend. Serious macro investors do not allocate entire portfolios to a single thesis, regardless of conviction level. This principle does not change during a Black Swan setup. It becomes more important. The appropriate strategic response to a high probability gap event is not panic buying. It is not liquidating existing positions to chase silver at any price. It is a measured, deliberate allocation adjustment that reflects the elevated probability of a significant repricing event without creating catastrophic downside exposure if the timing is wrong. History suggests a consistent framework that experienced macro investors apply in precisely this type of setup. First, they assess their existing precious metals exposure as a percentage of total portfolio value. If that percentage is significantly below their long-term strategic target, the current setup justifies accelerating the timeline for reaching that target. Not because of fear, but because the structural conditions for a repricing event have rarely been more clearly aligned. Second, they distinguish between assets that can be repositioned before market closure and assets that cannot. Cash positions, liquid holdings, and assets sitting in accessible accounts represent actionable capital. Frozen brokerage positions do not. The strategic question is simple. How much actionable capital is currently positioned to benefit from what the next 48 hours may produce? Third, they identify their Sunday night monitoring protocol. The GlobeX open at 6:00 p.m. Eastern is the first real data point of the weekend. The initial silver futures print at that moment will tell a serious investor everything they need to know about whether the gap is forming as anticipated or whether the weekend passed without the expected catalyst. This is not speculation. This is a systematic, disciplined approach to risk management in an environment of elevated uncertainty. The Sunday night watch, the 12-hour window that separates preparation from regret. Between Friday's closing bell and Sunday's Globex open lies the most important 48 hours in recent silver market history. During this window, three things will either confirm or challenge the Black Swan thesis developed across this entire briefing. Geopolitical developments, any escalation across the pressure points identified in Part 2, will immediately be reflected in Sunday night futures pricing. A serious development in the Persian Gulf, a significant policy announcement from Beijing, or unexpected breakdown in any of the monitored diplomatic frameworks will send silver futures sharply higher before most American investors have finished their Sunday dinner. Physical market signals, specifically the Shanghai premium data that begins flowing as Asian markets activate Sunday evening, will either confirm that Eastern institutional buyers are continuing their accumulation or suggest that the premium is narrowing, indicating reduced urgency in physical demand. Technical confirmation. The Globex silver futures print relative to Friday's close will either validate the structural breakout identified in Part 1 or suggest that the weekly candle close above critical resistance was a false signal requiring reassessment. A serious investor monitors all three simultaneously. They have already made their positioning decisions before Sunday arrives. They are not making decisions on Sunday night. They are simply observing whether their pre-positioned thesis is being confirmed by the data as it flows in real time. The final warning. Every Black Swan event in financial history shares one uncomfortable characteristic. After it happened, it seemed obvious. The signs were visible, the data was available, the mechanics were understandable, and yet the majority of investors, retail and institutional alike, were either positioned incorrectly or not positioned at all. Not because the information did not exist, but because they chose to wait for certainty before acting. In markets, certainty arrives after the move. Preparation happens before it. Right now, this weekend, the structural setup for a historic silver gap event is not a rumor. It is not speculation dressed in dramatic language. It is a measurable, documentable convergence of technical breakout conditions, physical inventory stress, Eastern demand signals, geopolitical pressure, and short squeeze mechanics, all arriving simultaneously at a moment when markets are closed and most investors are completely unable to respond. The bell will ring again on Monday morning, and when it does, the investors who understood what this weekend actually represented will already know exactly what happened. The only question that remains is which side of that bell you will be standing on.